Gold and silver needs to be at the financial base of your strategy so that you can live to rebuild another day. That's why it's considered the safest asset out there. But central banks, what are they doing? Always those that understand to advanced economies as well. And in fact, central bank gold purchases are up 82% year over year. 82%. Importantly, central bank gold reserves rose to the highest level since 1992. As Warner would say, what does this tell you? That they are getting ready for the collapse, the complete transition and complete collapse. And again, I will tell you, what in the world do you want to hold when we go into this transition? Because if what you hold are dollars, we're going to have a problem with that. So I've got a couple questions and I'm going to answer them. Kay Sarah says, who is selling all this gold to central banks? Great question. Some of it would be in the open market. So gosh, why aren't prices higher than they are? That's actually kind of the next question that Gerald asks, what's keeping silver so low? So I'm going to answer both of those questions because they really are kind of related. So some of these purchases will be in the open market. Some of them will be from one central bank to another. Some of them will be from the IMF to a central bank. But in either case, both gold and silver are severely, severely, severely undervalued because these are the two monetary metals. And a rising gold price is an indication of a failing currency. And with silver, it's the secondary monetary metal, but it is still a monetary metal. So even a rising silver price can be an indication of a failing currency. In the physical world, both of those are finite. So who do you really want to own the gold? I want me and you to own the gold. I don't want the central banks to own it. But they're buying it and they are suppressing the price because that's easy and cheap to do through derivative contracts. A derivative is derived from an underlying asset like silver and gold, but then it can never convert into those physical gold and silver. But you can control an awful lot of gold and silver on just a regular CME contract. $150 controls 500 ounces of gold and 5,000 ounces of silver. So by selling those derivative contracts, it makes it seem like there's a tremendous amount more silver and gold out in the marketplace. And that, my friends, is what is keeping these prices so low. So you have a choice here because you can actually believe the garbage that they want you to believe and stay inside the fiat system. Anything that you can only convert into dollars, euros, yens, whatever, that money is inside of the system. Or you can have real money, silver, gold, in any form is monetary at its base, that is truly outside of the system, that is truly decentralized, that has a proven historic track record. That's what safety is about, seriously. And it is absolutely time. If you don't have your strategy started, you better get started and get it done as quickly as you can. If you do have it started and it's not completed, you need to move forward with that. Surprised again. Wow, European factories send inflation warnings as France overshoots. And wow, all these people are surprised? And haven't they been surprised at the inflation right along? Why are you still listening to them? Are you surprised? Your boots on the ground. You go to the grocery stores and to the stores to buy, your energy and your food and everything. And they want you to believe that you're only experiencing 7% inflation. And even that is surprising to them. It's incredible. But you should not be surprised by any of this. Unexpectedly hits record. I don't think so. Now, I know that we're talking about the Eurozone in here, but that is one of the key central banks. And, they've held interest rates below zero. They have run that test since 2009. Well, Sweden was the first one to do it in 2009. So in the Eurozone, I believe they've run that test since 2010, and it hasn't worked. And now with global synchronization happening again, and this time I'm referring to bond synchronization and bond interest rates. And what is a bond? A bond is a debt instrument. So where people count on government bonds being the safest thing that you can do, I don't buy it, and I hope you don't buy it either. Because governments can and do default, and they are out of their element. Their experiments are failing, and they are losing control. And that is what this is really showing you. Central banks, is it all planned? Yes. We have no purchasing power left, and interest rates have been anchored at zero, or below zero even, since 2008. And all of this money printing has been about buying time to get into position to transition into that new currency. And I know the central bank's hope is that it's a CBDC, a central bank digital currency that they program and they control. I don't think that's such a good idea. I think gold is a much better bet because you can always convert gold into any currency, any good, or any service. But the reverse is not true. You can not always convert any currency into goods and services, or gold for that matter. So with all of these surprises, Christine Lagarde pivots on ECB hikes as switch in guidance seen soon. So what all these central banks, well, not all of them, but what the ECB and the U.S. is really doing, the Federal Reserve, is keeping interest rates low and continuing to pump in extra money into the economy and therefore pushing up inflation. So in this country, they are saying that they're going to do it until March. Okay, we've just entered February. They've been talking about that since November. This is ridiculous. It is absolutely beyond ridiculous. And so what are they saying? Asset purchase plans and other measures kept unchanged. So is this really a pivot? Heck no. And what's going to be even more interesting to see is when they do finally start to raise rates, or they actually do finally start to run off, in other words, sell their balance sheet or allow it to mature and not reinvest it, what that's going to do to the markets and how long they will be able to maintain that policy. My personal feeling, and I could certainly be wrong, this is just my opinion, is that they'll do it a couple of times, but I'm not sure that they're even going to make it 3. Even though we're told there's going to be 5 or 7 hikes and blah, blah, blah. I think it's all garbage. We're already watching the markets whipsaw back and forth based on all of this uncertainty. But remember, so much of market highs are based upon debt. And with interest rates going up, that debt that gets rolled over then has to pay more interest. And we've got a plethora of zombie firms out there in the global economy, not just the US, not just in Europe, I mean Japan, everywhere. And they can't deal with higher interest rates because they can't pay the debt that they have now, any of the principal. But central banks all over the world are now talking about, and we're going back, it's not quite a synchronized move in this, although the bonds move is synchronized. But look at anything in the gold, they just held the rates steady. So they're talking, and what they're really trying to do is to get the markets to self-police, right? Let the markets push the interest rates up, and then maybe they can wait on that. I don't know. We'll see what happens. But here in the red, so over in looks like Asia, they're cutting, and then the blue is hiking, so emerging economies, and then this black or dark blue is set to hike this week. So we've got, again, I'm going to use this analogy. I'm sure all of you have seen a bridge in a hurricane, and it's kind of swinging back and forth and back and forth and back and forth until it collapses. And I think that's what we're seeing here now. Because this is not a synchronized move yet, but the interest on the government bonds and the bonds that are out there are operating in a synchronized manner. But you have to ask, because they always say we have all these tools, and yet the only tool that you really hear about are raising the rates or running off their balance sheets. This is a global issue. Make no mistake about it. And the 10-year German yields jump above zero. They've been zero for a very long time. What does this tell you? This tells me that even though the plan is to make a transition to a new monetary system, and they have to, there's no purchasing power left, and interest rates are anchored at zero, and balance sheets are at nosebleed levels, debt is at nosebleed levels, and now we have negative rates that the markets are pushing up. So no more negative rates. Have the central banks lost control? Because that's what I'm thinking. I'm thinking and seeing that the central banks have lost control, or at least at the minimum are in the process of losing control.